Everybody ready? Good morning. My name is Myron Frans. I'm Commissioner of Minnesota Management and Budget, and I'm joined today by State Economist Laura Klumbakidis and Budget Director Britta Rayton to present the February forecast. You can review today's forecast documents online on MMB's website, mn.gov/MMB, under the Forecast and Updates tab. Our online materials provide additional details. Today, we are forecasting a positive balance of $1.052 billion for the 20 and 21 biennium. The budget balance is $492 million less than the November forecast, which was $1.544 billion. Our forecast has been lowered today because we have reduced our revenue projections over the next 4 years. We made this reduction to revenue projections because, number one, we are forecasting a reduction in economic growth in the future, and number two, we have seen a reduction in actual revenue receipts since November. As a result, our budget outlook has weakened since November. Today's forecast balance projected for $1.02 billion for 20 and 21 is in addition to our reduced revenue projections. We are also projecting some reduction in expenditures that will offset part of the reduction in revenues. Dr. Klumbakidis will discuss the economic outlook and revenue projections, but first, Budget Director Britta Rayton will discuss the budget changes.
I'm Britta Rayton, State Budget Director, and I'm going to walk through the math for the current biennium and the biennium for fiscal years 20 and 21. So this first slide shows the change in the budgetary balance in the current biennium since the November forecast. As you can see in the lower right-hand corner, the overall budgetary balance for fiscal years 18 and 19 has declined by $157 million since November. Revenue estimates have decreased by $198 million, and expenditure estimates have declined by $41 million. There is no change in the budget reserve in this forecast. The budget reserve balance remains at $2.075 billion, and the cash flow account remains at $350 million, for a total of $2.425 billion in the cash and budget reserves. There is also no change relative to the previous forecast for the stadium reserve, which remains projected at $50 million by the end of fiscal year 2019. The changes in revenues and expenditures leave us with an estimated balance of $563 million, which is available to balance forward into the next biennium. The amount of this balance forward, again, has declined by $157 million compared to our November forecast. So moving to the next slide, this slide provides the updated budgetary picture for fiscal years 20 and 21. And this is where you can see the $1.052 billion that is now projected to be available in the upcoming biennium. That's in the bottom row in the middle column. This is comparing the November forecast to the February forecast and then highlighting the change. Walking through the numbers, you can see that the beginning balance declines by $157 million from the previous forecast, and this is what I just walked through on the previous slide. Revenues have decreased by $386 million, and expenditures have declined by $51 million compared to our previous forecast. And again, there's no change in the cash and budget reserves or the stadium reserves relative to the previous forecast. However, the stadium reserve is still projected to grow by $48 million compared to the current biennium, reaching $98 million by the end of fiscal year 2021. The changes in the beginning balance, revenues, and expenditures lead to an overall reduction since November of $492 million and a projected balance of $1.052 billion. We will provide further detail on the drivers of the expenditure and revenue changes a bit later in the presentation, but now I'll hand it over to Dr. Klumbakidis to walk through the economic outlook.
Hello. So I'm going to start by talking a bit about the outlook for the U.S. economy and how that outlook changed since we last prepared a forecast in November. I will then move to Minnesota's economy and finally to the changes in our revenue forecast. The first chart compares the current U.S. real GDP forecast by Minnesota's macroeconomic consulting firm IHS to their prior forecast. The dark bars show the history and their February 19 outlook, and the light bars show their November 18 outlook. Focusing on years, so if you focus for a minute on the years 18 through 20, you can see that the near-term outlook for U.S. economic growth, especially this year, 2019, has weakened since our forecast was last prepared in November. Lower estimates of growth at the end of 2018 led IHS to lower their expectations for this year's real GDP growth from 2.7 in the November outlook to 2.4% now. They also lowered their forecast for 2020 from 2.1% to 2%, and they slightly raised their forecasts for 21 and 22. If you look at the current forecast for 18 to 23, so the dark bars on the right side of the chart, so those bars on the right side there, you can see that the pattern of slowing growth through our planning horizon carries over from the prior forecast. So that's those steps down that you see in the dark bars on the right-hand side of the chart. While current conditions can support moderate growth for much of this year, IHS expects the economy to begin slowing in late 2019. And this occurs as the contribution to growth from the federal fiscal stimulus declines, monetary policy becomes more restrictive, global growth weakens, and a strong U.S. dollar relative to our trading partners' currencies pulls down net exports. And then in addition to that, after mid-2020, IHS expects a demographically driven decline in the labor force participation rate for the United States, so a decline due to the aging of the workforce. And they expect that to slow the economy even more after 2020. So that downshift continues as growth decelerates from 2.9% annually in 18 to less than half that rate in 2023. The history on the chart, so on the left-hand side here, so it's the history of the years since the recession of 08-09 to now, illustrates one of the risks to this forecast. The dotted line is at 3.1%. That's the average annual real GDP growth for the 20 years prior to the Great Recession. So prior to the Great Recession, we could expect annual real GDP growth in the 3s. But that is much higher than what is in our current forecast. And when the economy grows slowly, there's not as much margin for error. It's harder to recover from a setback than when the growth is higher. And the U.S. expansion is expected in a few months to break the record for the longest expansion set in the 1990s. So in this forecast, it will indeed, if this forecast holds, it will indeed break that record. A mature, low-growth expansion is particularly vulnerable when negative economic shocks occur. This chart compares Minnesota's labor market performance to the nation's. The chart shows the headline unemployment rate, where the light line is for the United States and the dark line is for Minnesota. The vertical gray bars show the U.S. recession, so the white space between the gray bars represents the recovery and expansion periods between recessions. Minnesota's steady economic performance continues even as the U.S. expansion, as I said, approaches record length. But the state's ability to add jobs appears to be reaching the limit set by slow labor force growth. That slow labor force growth has been long forecast due to the aging of the population. Throughout the expansion, Minnesota has steadily added jobs, driving the state's unemployment rate well below the U.S. rate. Our unemployment rate currently stands between the low points of the prior two expansions at 2.8%. You can see that it's 0.3 percentage points above the low point for that record expansion in the 90s. It's more than 1 percentage point below the U.S. rate, half a point below where we were last year, the 7th lowest among states and the lowest we've seen in 18 years. The next chart illustrates, in addition to that low unemployment rate, it illustrates Minnesota's tight labor market. The height of the gray bars shows the total number of unemployed people in the state of Minnesota, and the dark bars, the height of the dark bars shows the number of job vacancies statewide. So in the height of the gray bars, you can see the peak of unemployment during the recession, and then you can see how that steady job growth I mentioned during the recovery and expansion has gradually whittled that number down. The dark bars show that job vacancies statewide have grown to a very high level. The ratio of unemployed persons to job vacancies statewide has been less than 1 over the past year and is now down to about 0.7. That means there are fewer unemployed job seekers than open positions across the state. And that tight labor market is being felt across Minnesota. So that ratio is below 1, both for the metro area and for greater Minnesota. The large number of open positions across the state illustrates strong demand for labor, and we expect that demand to persist in this forecast. But as retiring baby boomers dampen growth in the Minnesota workforce, our ability to continue to add jobs is increasingly constrained, and employers and job seekers have to become ever more creative to match people to jobs. As employers and job seekers adjust to this environment, Minnesota's labor market appears to be slowing down. Since last August, the unemployment rate is held at 2.8%, so it hasn't gone down since then. It's held steady there. And that, as I said, is just above the low point for that expansion of the 90s. And between 2011 and 2017, Minnesota employers added, on average, 42,000 new jobs each year. But in the 12 months ending December 18, employers added little more than half that many. Now, those data are subject to revision, but this could signal that we are feeling the impacts of a constrained labor force. So one important way all of this feeds into our tax revenue forecast is through our forecast of total Minnesota wage and salary income. And by total wage and salary income, I mean adding up all of the payrolls of all the employers in the state of Minnesota, and then we estimate how that number is going to grow over time. We continue to expect that number to grow. Wage and salary income will grow every year in this forecast, but we now expect weaker growth than we expected in November. The forecast reduction is due to several things. It's due to a downward revision to 2018 employment data. Okay, so those smaller job gains that I mentioned, those data are lower than what we thought we had when we did the November forecast. Lower than expected wage income growth last year. So again, a lower wage growth number than we thought we had in the November forecast. Recent weakness in Minnesota's income tax withholding receipts. So we look at withholding receipts to and infer from that wage growth. And a lower forecast for U.S. wage income from IHS. So this lower wage and salary income growth number Minnesota's is reflected in a lower number for the United States. And as a result of slowing employment growth, more of Minnesota's growth in total wage income is expected to arise from higher earnings per worker and less from increases in the number of people working. So moving to the revenue forecast, the first two columns of this table show the current forecast and the forecast change for the current biennium, FY 18-19, and the right two columns show the current forecast and the forecast change for 2021. Total general fund revenues for FY 18-19 are now forecast to be $198 million less than the November forecast. Lower expected individual income and sales tax revenue more than offsets higher forecasts for corporate and other tax revenue. The largest dollar amount change, as you can see in the chart, is in the current biennium, is in the individual income tax, which is forecast to generate $403 million less than in the remainder of FY19 than we had estimated in November. So far in this fiscal year, net income tax receipts are below our prior forecast, so that lowers the starting point for this forecast. So those lower revenues and lower forecast income growth, including that lower growth in wage and salary income that I mentioned, contribute to the reduced income tax forecast. Sales tax revenue in FY 18-19 is now forecast to be $19 million less than the November forecast. The lower revenue lower revenue forecast is primarily due to lower forecast growth in taxable Minnesota sales. So when we forecast the sales tax, we look at U.S. forecasts for spending on lots of different types of items, lots of different spending types, and we construct a proxy for Minnesota's sales tax base from all those different spending types. So all the things that are included in Minnesota's tax base, we look at the U.S. forecast for spending in those items. And that proxy sales tax base is expected to grow more slowly than what we had expected in November. That's consistent with that lower U.S. economic outlook that I showed you on the first slide. So lower economic outlook was also lower consumer spending. lower growth in consumer spending. The corporate revenue forecast is up $130 million, primarily due to higher than expected receipts so far this fiscal year. The Federal Tax Cuts and Jobs Act of 2017 made some big changes to corporate tax law, and businesses had to decide how to respond to that law. For example, some of the higher than expected corporate tax collections we've seen so far this fiscal year may have been due to corporations shifting the timing of their income to take advantage of the lower federal corporate tax rate in 2018 and not higher corporate tax liability in Minnesota. We had to make assumptions about how much of this revenue is due to income shifting and how much is actually a higher base of liability from which to start our forecast. So those estimates introduce risk to the revenue forecast. The forecast change for the next biennium shows a similar pattern. Lower forecast individual income and sales tax revenues more than offset a higher corporate and other tax forecast. And that lowers the revenue forecast for 20 and 21 by $386 million. And the dynamics in the next biennium are similar to the dynamics in the current biennium. Lower starting points for the income and sales taxes, so that lower current biennium forecast lowers the starting point for the next biennium forecast. Those lower starting points for income and sales taxes combined with lower growth in taxable income on the income tax side, and lower growth in taxable sales on the sales tax side, to reduce the 2021 income and sales tax forecasts. And a higher starting point for the corporate forecast raises our expectations for FY 20 and 21 corporate receipts. So if you'll recall that deceleration in economic growth I showed you in that first slide, that deceleration over our planning estimates, note that growth in total revenues is also declining over the 3 biennia included in this forecast. Revenues are still growing across all of these years, but the pace of growth is slowing. So on this chart, we illustrate that between the last biennium and the current biennium, total revenues grow on annually 3.2%. And then moving to the next biennium, 2021, that growth slows to 3% per year. And then by the end of our planning estimates, that growth has slowed to 2.3% per year. And Budget Director Rayton will explain how that affects our planning estimates. So let me conclude by drawing your attention to some of the risks to this forecast. The Federal Tax Cut and Jobs Act made big changes to federal tax law, and individuals and businesses are still had to decide how to respond to the law. But we haven't yet seen Minnesota tax returns for 2018, and we're still dealing with uncertainty about how taxpayers actually did respond to those changes and how their choices affected Minnesota tax revenue. The uncertainty about corporate receipts that I mentioned earlier is one example of that kind of risk. So while Minnesota's law stayed the same, changes that people made in response to the federal law affected what they paid into the state of Minnesota. Minnesota's employment gains appear to be increasingly constrained by slow labor force growth, but that is baked into the current forecast. But if labor force growth grows even more slowly than we expect, our employment forecast is at risk. And our forecast of total wage and salary income depends on higher earnings per worker as employment growth slows. This forecast, moving to some US level or global level uncertainties or risks, this forecast assumes that all of the US tariffs and retaliatory measures that were put into place last year are permanent. But as you know, US trade policy, especially regarding China and regarding the new NAFTA agreement, has been in flux. So prolonged uncertainty about trade policy can slow down business investment, and that can affect GDP. I talked about slowing global growth that's baked into this forecast, but with slower global growth, geopolitical events can derail global growth. For example, if the UK exits the European Union without an agreement, that can disrupt exports and that can disrupt global growth. And then finally, with 28 months before the end of FY 20 and 21, we have not yet seen any of the total revenues we forecast for those years. Even small changes to assumed growth rates, especially in particularly volatile sources, income sources like capital gains and corporate profits, could materially alter the budget picture into our planning horizon. So I'll now turn it over to Budget Director Rayton.
So I'll quickly walk you through the expenditure side of the forecast. Expenditures are down relative to forecast in each biennia. The slide focuses on the changes in fiscal years 20 and 21. The overall change in expenditures is actually very small in this forecast, just 0.1%. E12 education expenditures are down $48 million from our previous forecast. This is due to lower actual student counts and lower free and reduced lunch concentration rates. This is partially offset by an increase in special education aid. The change since the previous forecast is less than 0.2%. Property tax aids and credits have increased relative to the November forecast by $29 million in fiscal years 20 and 21. This is largely due to growth in property tax refunds for homeowners. This increase is based on an increase in the actual payments made to homeowners this year and slower projected income growth assumptions into the future. Health and Human Services expenditures are forecast to be $30 million, or 0.2% lower in the next biennium compared to our previous estimates. Medical assistance spending is up $13 million from the November forecast and is driven by higher spending in long-term care programs. That increase is more than offset by lower than expected spending in other forecast programs. $32 million of this change is due to lower spending for chemical dependency treatment. The debt service forecast in the all other category of spending is virtually unchanged from the November forecast. Moving to the next slide, this slide provides a look at the planning estimates in fiscal years 22 and 23 and shows the structural balance between revenues and expenditures in both fiscal years 20 and 21 and fiscal years 22 and 23. That means it removes from the chart the impact of balance forwards into those bienniums and the impact of changes in the reserves. You can see in this chart that the structural balance declines into the planning years, and on a structural basis, the number is actually very slightly negative in fiscal years 22 and 23. I also want to highlight that this view is just representing the structural balance in the general fund. Not included in this total is the projected deficit in the Healthcare Access Fund. With the expiration of the provider tax, the Healthcare Access Fund is now forecast to have a $919 million deficit in fiscal years 22 and 23. Also, I want to highlight on the right side of the chart, you can see that projected annual growth rates of spending and revenues between 2021 and into 22 and 23. Spending in the general fund grows over this period at 2.9% annually, which exceeds the 2.3% annual growth in revenues. The biennial growth in expenditures shown here is just the growth that is occurring in forecast programs. The biggest driver is the growth in medical assistance. And then at the bottom of the chart, you can see an estimate of inflation. Inflation is generally not included in the expenditure estimates within the forecast, except in those programs where there is an inflationary component in a formula or where the formula is based on actual costs. Some examples of places where inflation is included in our estimates is property tax refunds, special education, a portion of healthcare, and in debt service. The estimate of inflation included on the slide is only applied to those expenditures where inflation is not already included, and it's based on the Consumer Price Index as the measure of inflation. It also compounds over 2 years into fiscal years 20, 21, and over 4 years in 22 and 23. So that's why you see the growth out into 22 and 23 in that inflationary estimate. And then I'll pass it back to Commissioner Frans.
As we examined our forecast from last November, we have confronted a number of uncertainties as described by Dr. Klumbakidis. The 2017 federal tax bill continues to be a source of uncertainty in trying to predict how taxpayers reacted last year and how they will react this year. During the last 3 months, the U.S. economy has also continued to face trade policy uncertainty, and our consultants, IHS, have lowered their U.S. GDP projections. All of these uncertainties are reflected in this forecast. As you know, we are in the first year of the Walz administration, and we released our budget proposal last week and our bonding proposal on Tuesday. Our budget outlook has weakened, even though we continue to forecast a balance of a little over $1 billion for 20 and 21. It's important to note that all of our spending for 20 and 21, as Budget Director Rayton mentioned, does not include the impact of inflation. If we were to include the effect of inflation, we would need to add an additional $1.1 billion of spending to this forecast. We must be mindful of this cost pressure in the budget process so we were able to fund services at current levels. This administration faces these new economic and budget concerns with a $2.4 billion rainy day fund, a AAA credit rating by the bond agencies, and a recently enacted pension reform bill. We added $491 million to this reserve in November of 2018 as part of our smart fiscal policy of an automatic budget addition in November when there's a balance. As you will recall from the governor's budget proposal last week, the governor was cautious about the changes that this forecast might bring, and we left $789 million on the bottom line to better adjust for these lowered projections. So we must now, with caution, address these different changing projections as we go forward, and over the course of the next several weeks, the governor will review his budget, and he'll be out in a few minutes after we get done answering questions to talk about how he's going to view this as he goes forward. But with that, we're happy to take questions, and once we're done, we'll invite the governor out. Any questions? Yes.
So if you account for inflation, is one way to look at it is there is no surplus?
Well, and yeah, the inflationary projection for the spending would exceed the actual budget balance that we're projecting for 20 and 21.
So is this really a shortfall, or is it a surplus?
Well, we've struggled with this issue since 2003, and I think one of the issues that we have to address, and it's one of the reasons the governor proposed making some changes in his budget proposal to add inflation back to several tax revenue positions, is we need to start addressing this. The governor does want to address this. He's mentioned this before, and one of the goals that we will have over the next several years is to figure out ways to bring inflation back into the budget cycle to make it more reflective of reality. But this is the reality that we face, and we face it every year, every budget session, time after time. It's something we're going to have to address.
I don't think you used the word surplus. I think you said positive balance. Is that on purpose? Is there a reason?
Yes. So we have a surplus in the fiscal year 2019. We have an enacted budget, and we actually are projecting a surplus in that budget in that year. We have a projected balance in 20 and 21 because we do not have an enacted budget for 20 and 21. That's how we make the distinction between a surplus and a positive balance going forward. And then in the 22, 23, it's either a planning balance or a planning deficit, depending upon the situation. In this case, it's an $11 million or a 0.02% deficit in 22 and 23.
Why do you sound so calm?
Wow, why do I sound so glum? I'm not glum. I'm just as happy as can be. Well, I told the governor, when you look at the labor shortage and the tightening labor market, I said one of the best things he could do for the aging baby boomer population is to keep me employed in order to keep down that reduction in the workforce. He seemed to react positively to that, so I'm pretty happy about that. I'm not glum. I think it's a cautionary tale, clearly. When you take $500 million out of the projection for 20 and 21, that's a concern. So just to to do the high level numbers, we had about $1.9 billion in projected balance for these 4 years, and we've taken out about $959 million from that projected balance. So there's a $492 million reduction in 20 and 21 and a $467 million reduction in 22 and 23. So those are not the numbers I'd prefer to see, but they're numbers that we can manage and work within. And I think after already briefing the governor this morning, looking forward to ways to enact a budget he thinks is the right policy decision. I think that's the key here is understanding that we're still in a positive situation, but we need to be cautious about how we proceed. We need to make sure that we look to whatever revenue changes we make or whatever spending we do has got to be balanced for the long term. And one of the things that the governor and I talked about already this morning was if there's ever a case to really protect the general fund, for general fund functions, it is now. I mean, we've always made the argument that the general fund is for education, it's for healthcare, it's for some healthcare, it's for public safety, and it's and when you start dedicating the general fund to transportation, and so one of our issues that we've talked about is the $460 million that's currently dedicated in the general fund for transportation. The governor's tax and transportation proposal would replace that with the sales tax or the increased gas tax. So our fundamentals remain the same. We need to protect more than ever now the general fund to make sure it's used for those things, and transportation and transit should be funded separately outside of the general fund. Same thing in the provider tax. If we don't take care of the provider tax now, it is going to have a general fund effect soon. So these signs indicate that we need to be cautious and really thoughtful about the policies that we enact.
Provider tax surplus takes you out how far?
I'm sorry?
Provider tax surplus takes you out how many years?
The deficit occurs in 22 and 23. So it rolls forward after this year when if it would sunset, it continues, and then the deficit hits in 22 and 23.
Question for Dr. Kalamakidis, if I may. Doctor, it appeared that the factors you were citing about the change in Minnesota were either national or global or demographic and not peculiar to Minnesota policy. I want to be sure I'm hearing that correctly and wonder if there are any particular Minnesota policies that you would lift up either as contributing to this slowdown now or as remedies for blunting the slowdown going forward that you would recommend.
So you understood correctly that the factors that we start with the U.S. economy, and that the factors contributing to the slowdown are mostly coming externally. So they're external risks. Minnesota's economy is closely tied to the U.S. economy, and so we tend to follow that. In terms of factors that or policies that could help in this environment, where the main factor I cited is the tightening of the labor force growth, is I would say that Minnesota needs to continue to be a place where people who are looking to relocate from other states and from around the world, it needs to look like a place of choice. And so we need to continue to be attractive to folks. One of the bright spots in our labor force story is that in both 2017 and 2018, we now know that Minnesota gained people on net from other states, reversing a 15-year pattern where we lost people to other states. And so we need to continue to be the place that people choose. In addition, for any given amount budget, looking at that whole portfolio of options and targeting investment to programs and policies that will strengthen our workforce and lower barriers to people entering the workforce. So we do not have a deep bench of people on the sidelines in Minnesota, but we do need to make sure that everyone has an opportunity to join this workforce. And so lowering barriers, making it seem attractive. But the challenge with regard to a slowing labor force growth is something that employers are facing. And so they are the ones who also have to be more creative about their own, the way they operate, the way they look for workers, the way they hire. They're having more flexible workplaces, raising wages, all of those things.
Doctor, are we headed into a recession?
Let me go back to the first slide. As long as these bars represent real GDP growth, as long as these bars are above the horizon, as long as they're going up, that means GDP is growing. And so in this forecast, this is a recession over here where it goes down below, right? So we don't have that in this forecast. So IHS and other macroeconomic forecasters are expecting this slow growth to continue. There are risks to the forecast that could turn that around, some of which I've cited.
Minnesota fall into a situation where our job growth is significantly below the national average because of this tightness of labor market and some of the other issues. Can you talk a little bit more about that?
So what we anticipate in our forecast, so what we've estimated will happen, is that as Labor force growth is slowing, and again, this has long been forecast. It's the aging of the population. We are not the only state. Every state is dealing with this, and the nation as a whole is as well. Is that as that happens, as employers get more creative about finding people, they're also going to raise offer wages, and earnings per worker will also increase. And so that is what keeps our revenues growing, our income tax revenues growing, and our wage and salary income growing going forward. So that is what we anticipate.
Concern about federal tax reform on collections and payments. Is that all on the corporate side, or is there a risk on the individual income tax?
So there are the Tax Cuts and Jobs Act of 2017 made big changes to individuals, business owners who pay their taxes through the individual income tax, and to corporate taxpayers. It's complicated. Lots of people have been trying to figure out how to manage their affairs under this. I mentioned one aspect of that uncertainty was the corporate issue. On the individual income side, we have seen a softness in or weakening in estimated tax payments in the fourth quarter of 2018, and that may have been due to some shifting, some behavior changes for individuals on the part in response to the Tax Cuts and Jobs Act, or it may have been because the stock market declined at the end of 2018, and so they realized losses. And so we've had to make estimates of which of those things is playing through and what the implications will be for Minnesota revenues.
To follow up on that, is the behavior of Minnesota taxpayers that they're paying fewer taxes now because of the tax bill, or the story has been that Minnesotans were going to pay more?
So Minnesota's tax law didn't change. And so all of these uncertainties I'm talking about with regard to the federal law have to do with just the federal law and people responding to the federal law. And so largely the uncertainty has to do with timing. So when we see receipts coming in ahead or behind forecast, we have to estimate whether that actually was a change in tax liability or whether it was a timing shift. Those are the estimates that we've presented today.
Let me just make one more comment, and we'll get the governor up here, just to deal with this glum issue. If this chart were reversed, I would be glum, all right? With that, we'll put this at the end and invite the governor to come up and make some comments. Thank you.
Good afternoon, everyone, and thank you for joining us. Thank you, Commissioner Frans, Budget Director Rayton, State Economist Kalamakidis. We appreciate your insight and the work that your team put together. Given the revenue collections over the last 3 months and projections given earlier this week by Federal Reserve Chairman Powell, it's not surprising there was a change in the budget forecast from when we stood with you in November. This forecast validates the approach that we proposed in our budget last Tuesday. We must make investments that continue economic growth, and my investments in education, jobs, and transportation will do just that. Now, I know when I finish, whether it's here or somewhere else, our Republican friends will come and take this place, and I'll just save you all time and tell you what they're going to tell you. Cut taxes and cut spending on education and those things that actually grow the economy. This trickle-down economic theory that no matter what the budget forecast says is what we have to do is what gets us into these problems. Had we followed their advice and had we followed what they're proposing, we will blow billion-dollar holes in our budget. It will come from the general fund, and the very investments that will allow us to grow in an economic slowdown will be taken away. The ability to have the best qualified workforce, the ability to have the best transportation system, the ability to have prosperity in communities that attract people to come here. So leaving that in there, they will try and pay for those on the backs of our children, our elderly, and our most vulnerable. This budget looks to the future, which is exactly what you need to do when facing slower economic growth. We left room in our proposed budget to help provide a cushion, and we will work with our commissioners and stakeholders to provide a revised budget recommendation in the near future. Now's the time to continue to protect the budget reserve and the general fund and help grow our economy with strategic investments in healthcare, education, and community prosperity. This is a fiscally responsible budget and bonding bill that at exactly this time of slower economic growth will continue to position Minnesota as amongst the best states, not only in the upper Midwest, but in the country, to attract businesses, to grow economic prosperity for families, and have us continue on a path to greater prosperity. So with that, I'd be glad to answer any questions.
Governor, what about attracting more people? There seem to be real concerns about the demographic decline in the workforce and that we need more people to move to Minnesota. What can you do to get people, not just from around the country, but around the world, to come here?
That's exactly right. And the question is about how do we attract people. This happened in the campaign. I made it a very clear place about this. Minnesota needs a place that's welcoming to immigrants from other states and from other countries. Minnesota needs to be a state that when you come here, you're going to be respected, you're going to get the opportunity to prosper. We also need to make sure that the amenities of why people move. When they ask people why they move or relocate, the one thing that doesn't end up in the top three is taxes in many cases. It talk about the quality of their schools, about opportunities. So the one thing we can do is we can make sure that job growth opportunities through the best qualified workforce, the healthiest population by making sure that our healthcare system continues to grow out and provide that quality care they need, and then making sure when we talk about community prosperity, those amenities that make communities look attractive to folks thinking about moving here. And we should reach out. This last week at the National Governors Association, I spent a considerable amount of time sitting down with the ambassadors of Canada to the United States, the ambassador of Mexico to the United States, and the ambassador of Japan to the United States, and visited them both at their residence and in set-down one-on-one meetings about making sure we're bringing folks here and telling them why Minnesota is an attractive place, with a well-qualified, well-educated workforce that has a work ethic that is world-renowned. And the response was positive from each of those. So as governor, my job is to go out, continue to make those cases, continue to show that the investments, and to make sure that we don't make that fatal mistake of the very thing that makes Minnesota so appealing to people is the things that we cut in a budget.
Follow up specifically on that. You're not at the federal level anymore. What can you do as a governor, as a state, on immigration?
Yeah, we can do what I said during the campaign. Putting up a sign outside of Minneapolis and telling people they're not welcome is certainly not the way to do that. I will stand with our immigrant communities, I always have, to make the case that this is a state of immigrants. This is a state that is open and welcoming to immigrants. We continue to ask the federal government to do comprehensive immigration reform, to get beyond this simplistic dead-end argument about a barrier when we need to be talking holistically about what it takes. And I think here in Minnesota, we know this, that immigration spans the spectrum of economic opportunities, whether it's agricultural production or whether it's researchers in neuroscience at the Mayo Clinic. That's what immigration brings to Minnesota, and as governor, we'll continue to push for it. But you're right, the federal government has to move. We can certainly send that message to folks that, that you will be welcome to Minnesota.
Growth is in fact slowing, which could lead to people possibly losing their jobs. Is now the time to increase things like the gas tax and things like driver fees?
Yeah, the question is the one that comes up. This is the conundrum about what people happen. The very things that grow our economy, and most would agree, at a national recession, and this is not a recession, it's a slowdown, but getting ahead of it in job creation, one of the best firewalls against a downturn is investments in infrastructure. It has played out time and time and time again. Now is exactly the time that we should invest. Those are jobs in our communities. Those are disposable incomes in our communities. Those are the things that increase growth. Because again, we need to have this honest conversation. To do nothing in this state about transportation costs over $1,000 a year to people. Now I heard somebody make the argument to me the other day. They figured up the gas mileage on their F-150, and they told me what it was going to cost extra. I said, in that logic, why wouldn't you argue to take the gas tax to zero then? And the person said, well, we need roads. And I said, that's our point. Our point is in the job creation and what we need to do. We make sure in this that the Working Families Tax Credit shields those folks that are making $45,000 or so less from the fullest impact of it. But those are job growth creators. Those are the things that move forward. And I think what it says here, this is not a downturn of people losing their jobs. There are not enough people to fill all the jobs that are available. And as the economist said, one of the things we're going to see is we hope to see it more than we have from the President Trump's tax cuts, is starting to see real wages start to rise, not just in that top 1 percentile that was seeing the the vast benefits. So we think it makes sense to invest in what makes Minnesota competitive, to invest and provide that firewall against a downturn by creating a lot of local jobs and an economic boost, and making sure that Minnesotans have the capacity to drive on safe roads, get to places faster than they would have, and attract people to work here.
Republicans are going to come up here and say that's at odds with trying to attract people here if their tax burden keeps going up and Minnesota's in the top 10 or top 5 of all these categories. So how do you thread that needle between?
Well, they would be wrong. People are moving here. And again, it's not the project. They keep telling me this. I said, what is your goal of moving us out of the top 10? Because if you work at that hard enough, would you like to move us into the top 10 worst states in education, top 10 worst states in health outcomes, top 10 worst states in personal income? Because we rank in the top 5 of all those. We rank in the top 3 of personal happiness amongst Minnesotans. So the goal isn't at the end state of this. I'm very cognizant of working families, making sure that folks are able to keep as much of their income as they can. But for a working family, the ability to have a quality school, the ability to have amenities in our community, because again, I guess it doesn't make much difference if you can build a swimming pool in your backyard. But when I watch communities in greater Minnesota, one of the things they have to do is close their community pools in the summer because they don't have enough in that. We're going to continue to make the case. Again, this is no surprise. This is trickle-down economic theory. There is one tool in the Republican toolbox: cut taxes. Cut taxes, cut taxes. At this case in time, we are cutting taxes for working Americans, for the working Minnesotans that are in the middle, but we're making strategic investments that grow the economy. I am not going to turn away from this because I want to be clear. If they decide that they're going to allow the sunset of the provider tax, that is a $900+ billion hole in this. And their only place to go for that is our children, our elderly, our veterans, the things that come out of the general fund. If they are not willing to have what we've always done in this state, separate financing for transportation opposed to the general fund, we will eventually bleed that off. And if they are not willing to look at the next 20 to 30 years, Minnesota will go from 5.5 million people to 6.4 million people over the next 30 years. That's going to be more congestion. That's going to be more people in schools. It's going to give us more opportunities for job growth. But if we're not building the infrastructure necessary, we won't get there. So I don't believe they have any proof historically to show that that works. I don't believe that they have any indication that Minnesota has driven people away. And I don't think there's been any indication that Minnesotans' personal finances and personal happiness haven't continued to grow as we've made those investments.
Governor, you come in here with a budget that includes a big gas tax, some fee increases, and then a bonding bill that in an off year is the biggest.
There is no off year in bonding. There's only been 2 years we haven't bonded.
And well, in an odd numbered year. What does this say about given this is your first term, these are your first big proposals, what does this say about the way you're going to approach divided government and the way you want to see Minnesota go?
Yeah, well, the way I'm going to approach any government, whether it's divided or not, is based on the facts and changing as circumstances change. We propose a budget that makes sense, that grows Minnesota's economy, that keeps us in a balanced budget and a stable financial situation, keeps our AAA bond rating. Again, this is the one that always kind of, I have a hard time wrapping my mind around. At a time of the lowest interest rates and the need that is acknowledged by all, it makes sense to bond at a time when we can get the best rates to start relieving that. So we have a $600 million corrections backlog in physical plant. What do you expect to do with that? Are we going to leave bad sightlines and allow people to be killed? Or are we going to address them? Why would we not fix those things on the front end at a cheaper rate to pay them off sooner than to wait till the crisis gets worse? So I don't approach it necessarily as divided government, but I do remind people the Senate was not up for election in 2018. And the people spoke pretty strongly about the Minnesota House. They spoke pretty strongly about this governor's office. And I was very clear about what I believed would grow Minnesota's economy and what Minnesotans believed it would. And I promised to propose for them a fiscally sound budget that invested in a quality of life second to none that made sense for Minnesota's future. And that's what I think we've proposed.
I mean, not me specifically, but with the labor shortage, I think economists have been expecting wage growth to be increasing, and we're still not seeing it in any levels.
Well, and 85% of the tax cuts went to stock buybacks, and the vast majority went to corporations. When Amazon pays 0%, now they want to come to Minnesota and find in my tax conformity bill that they should get another tax cut, I guess, so they can pay less than zero and we'll pay them just to exist. That's what happened. This is trickle-down economic theory in its classic state. None of that, and a large proportion of it, did not raise wages. And it's going to become more difficult. It's why you start to see here in Minnesota, large employers embraced $15 minimum wage. Large employers embraced paid family leave because they know it's much cheaper in the long run to attract and retain a quality worker than it is to just churn through them. So I hope that question, Peter, gets asked when the Republicans take this spot. Why aren't Minnesotans getting a raise? And as the state economist said, we're going to have to count on those raises to come in because there's not enough people to fill the jobs. So there's not going to be a broadening of the tax base by more people getting hired. It's going to have to come from rising wages.
Do you plan to pull back any of your initiatives you laid out last week, or trim them down to
No, my pledge is to go back through line by line with our commissioners and with our stakeholders. It would be irresponsible not to in light of the new forecast. I think my team right now, as I asked them as of this morning when we saw these numbers as you did, to go ahead and start looking where that needs to happen. And again, that's just responsible budgeting.
Are there any places where you know you'll go?
I can't say at this time. After the last 2 days, I feel like investing more in the cure for a common cold, but pardon me. No, we're still looking. I think it's pretty obvious for folks where you see where we spend money on healthcare and education and things. We're going to have to look and make hard choices. I'm willing to make those hard choices. What I'm not willing to do is take an ideological approach to every single economic situation and say tax cuts for the wealthiest and corporations will grow Minnesota. We simply aren't going to do that.
So will you mostly stay the course with your budget and bonding, maybe just with some tweaks? Is this not having a major impact on either of those proposals?
Yeah, because, well, the one thing is, and again, I'll get into more details, Tom, when we get into it, we purposely left a lot on the bottom line in anticipation of where this would go. Part of that was knowing that it's hard when you have to revise. We've got a lot of stakeholders, whether they be elderly Minnesotans, whether they be our littlest Minnesotans looking for childcare, those types of things. Once you put those proposals out there and then you have to start coming back, I'm certainly understand that that's what we're going to have to go look at. We'll look through line by line, just like we did when we wrote this budget.
Question for the DFO. If I look at the question, the revenue growth, it's slowing to about 2.3%. If you've read your Thomas Piketty, that's about what the norm is over the centuries. This post-war economy's been 3 to 4%. Are you worried that this reflects the stabilization of that norm?
Yeah, thank you for doing that. I spent about a month reading that and going through, and this idea of the wealth disparities is starting to happen. Yes, and again, I think something needs to be called out. When we did these tax cuts, we were going to get 5 to 6% GDP growth. And when many of us said, we don't think we're going to get that, they said, yes, we would. If the chart that was up here shows you that sugar high that we got in growth that came out of the 2017 tax bill is starting to come down. Yes, I think there is the potential that there may be a little more of the norm over long-term growth. Our economy is a mature economy. I think it bodes more now than ever before. Investing in those fundamentals that we know are at the heart of the economy, the best qualified workforce, the healthiest workforce, and those infrastructure pieces, whether it's broadband, highways, or transit, that allow people to grow is going to put us in a better position. But I think, yes, I think that is probably more of the historical trend. It's been down a little bit, but we saw this, and it's nothing surprising to anyone. We exploded the deficits, and many of you followed my time in Congress. I am a deficit hawk. I do think they matter. I think the good thing about state government is that need to have a balanced budget, but we don't also have all the tools in our toolbox that at times when you have some of that spending that stimulates growth, we saw that worked and pulled us out of the recession. But there's a whole nother school of thought that says austerity is the way to do that. Now, that's never worked, but it won't stop people from trying it. All right. Thank you all for that. Thanks, Myron. Appreciate it. Britta, thank you.
Well, it's clear that the shortage in the workforce has started to constrain our future economic growth. So you know that the House DFL caucus is really invested in doing those things that will improve Minnesotans' quality of life. And I think after seeing the budget forecast, we'll be doubling down on policies that are important to keep Minnesotans in the workforce, like improving childcare access, paid family leave, earned safe and sick time. We have a very high labor force participation in Minnesota, but we have to do all those things that we can to make that labor participation rate even higher. So we'll be focused in on that. We'll also be focused in on investing on those things that keep our workforce strong. Higher education, K-12.
We also have a leader who's not feeling well.
A lot of germs.
There's a lot of terms. This economic forecast and budget forecast is not about numbers. It is about the people of Minnesota, their jobs, their families, and our future together. We know that our economy is continuing a pattern of growth, but the rate of growth is slowing. It is slowing because we have fewer workers able to enter the workforce. We don't have enough people moving into Minnesota to make up for that shortfall, and we are going to be in a period of slower growth if we do not invest in workforce, if we do not attract immigrants and migrants into Minnesota from other states, if we don't make a higher education system that prepares workers for that workforce, and if we don't have the kind of family economic security measures that keep people attached to the workforce, things like paid family and medical leave, which allow people to care for their families and continue working. We believe very strongly that investing in the people of Minnesota, making them productive and making sure that everybody has a share of the economic benefits that our economy produces is the best way to keep people working, keep families secure, and make sure that we have a brighter future. And while we are doing this, we have to look out for the state budget, which looks increasingly dire in future years. We are looking at operating deficits into the future unless we address revenue and spending. And with an aging population, the need to take care of people as they get older, a rising workforce that requires more in schools because we have more people in poverty, we need to invest more in education from zero through college. And so this is not a time for us to backtrack on investment in the people of Minnesota. It's a time for us to go forward. And that is why we are very much aligned with Governor Walz's proposals on revenue and spending in this coming budget cycle, and we look forward to working very closely with him to enacting his budget this year.
Well, I'll make just a brief comment. When we had the November forecast, I emphasized at a meeting just like this about our need for more workers. And we have an aging workforce, and we're going to have to focus on those investments that you've heard from both the Speaker and Majority Leader about where we target those investments. Education, job training, to begin to offset the need for a quality or an improved workforce. We have a quality workforce, but we have an aging workforce that we have to be cognizant of. I do want to mention that we are well prepared to move forward. The Speaker and I and others have been meeting regularly in terms of developing the state budget. And now that we have the forecast, we'll be ready to move forward in the next couple of weeks, setting the budget targets for the various fiscal committees. And I think we'll be looking very closely at the proposals that Governor Walz has made. I, for one, think he's got the right priorities, and they match the priorities of the DFL caucus in the Minnesota House.
So your inflation worries from December are still there. It looks as though maybe we're at an even point as far as what is in the surplus and what is available. Can you get by with just a flatline budget that now has enough money to cover inflation? Or as you guys seem to be saying, you think there should be some increases in both revenue and spending?
Well, we need to make some investments because if you look in the out years, we have a pretty large projected deficit. So we have to ask ourselves as state lawmakers, what are the things that we can do in this biennium to ensure that we don't have a $2.5 billion deficit in the next biennium? And it is just not sustainable for us to continue to provide the services that we currently provide to Minnesotans at the level of revenue that we're currently bringing in. So unless we plan to cut education or cut healthcare, we have to look at the revenue side of the equation in the next 2 years. We also have to look at what can we do to stimulate economic growth. What we can do to stimulate economic growth is twofold. We can get people working. There are people on the sidelines who will get in if they have the opportunity to have paid family leave, earn safe and sick time, more childcare subsidies to help, in particular, women fully participate in the workforce. But also we need to invest in Minnesota's hard infrastructure. This is a time to go big on a bonding bill. This is a time to go big on transportation investments and create those jobs. We're not like the federal government, so we can't deficit spend with a tax bill that's not paid for. But we do have low debt per capita compared to the rest of the country. So we certainly could invest in a very sizable bonding bill and get a lot more people working.
The bonding bill.
Well, I think $3 billion would be about the right number, but my understanding is we're looking at maybe a maximum from the administration standpoint of $1.5 billion. I don't think it's a time to go small. If you look at Minnesota compared to the rest of the country, our debt per capita, we almost have half as much debt per capita as Wisconsin. So it would be a very responsible investment for us, especially when you look at the rate of inflation, construction inflation, and the rate of interest. It's still a good deal for us to borrow and build.
Votes for a bonding bill, if I can follow up on the bonding bill, and it's time to go big on that. Are you working on getting votes? How is that going on the other side of the aisle?
Well, we have 49 billion other problems to solve first before we get to the bonding bill conversation. I think you're familiar with that the bonding bill is usually the last piece of the puzzle that comes together. There are a substantial number of Republican bonding requests that have been put in, and Chair Mary Murphy assures me that there is a large appetite on the Republican side of the aisle for bonding.
I would just like to add, if you look at slide 12, we are currently in a structural deficit if you include inflation and take out one-time money. So we've got some money left over in the bank. It's not recurring. And we've got $1 billion in projected inflation for the next biennium and $538 million for a structural balance. So we are in a structural deficit going forward unless we address spending and revenue. One-time money might get us through one more session where we're not taking this seriously, but we can't continue to do that, and we will set ourselves up for even more difficulties later if we don't get a handle on it this year.
Mr. Leader, Madam Speaker, the administration's argument is we need to protect the general fund. One of the ways to do that is increase the gas tax. Your thoughts on that?
Well, absolutely. It's a user fee, and if you look around the country, my understanding is in Ohio, when you have Republican Governor Mike DeWine proposing 18 cents in a gas tax, it is a user fee, and those who use the roads pay proportionally more. Also, we have found in 2008, when we overrode Tim Pawlenty to invest in transportation, that people knew what they were paying for, and they were pleased to be paying for it. We did not have a backlash against people who voted for the gas tax increase. That increased investment resulted in projects. A third lane on Highway 10 from Egret to Foley. We had substantial improvements in 694, and we don't all love road construction, but you could see the impact of those projects on easing congestion for people. So I think transportation is definitely a place we'll be looking.
You've got the votes in your caucus to pass a bill off the floor.
We do.
Okay.
I think you might have been asking too about the idea of ending that transfer of general fund money to transportation projects and bringing that back in. I think that's what the governor was referencing when he said protecting the general fund. Does that sound?
Yeah, I think the governor's original budget had $450 million coming back to the general fund. And it's important to remember that the healthcare access fund going into deficit is also going to put a big strain on the general fund going forward. So without a gas tax or renewal of the provider tax or some replacement for it, we are going to be in a significant structural deficit in the general fund, which means less money for education, less money for taking care of seniors and people with disabilities. The consequences are very real, and we do have to address. I mean, we don't have to do these things. We do not have to take care of people when they are vulnerable. We don't have to have a world-class education system. But if we want to have that, we have to pay for it, and that's what we're going to be working to address.
You guys are looking to pare back spending.
Well, I have asked all of our fiscal chairs to look as they go through their budgets. What are the things that we're spending money on that we shouldn't be spending money on anymore? I think over the years, we've talked about concepts like zero-based budgeting. I do think every year that is our responsibility as legislators when we're putting together the finance bills, that the chairs of the committee really dive in deep with the commissioners and the staff at the departments to make sure that there is all the spending that we're doing on behalf of Minnesota's taxpayers is resulting in positive effects. And I'm hoping we can find some things to trim. There have to be some, right?
a lot of the governor's new revenue comes from his tax conformity bill. Where will yours come from? Do you have an idea about how you would raise new revenues to cover some of these priorities?
Well, Representative Marquardt will be putting that package together, but I think it's fair to say it will look fairly similar to the governor's proposals with probably some modifications.
So is this going big? Go big on bonding, go big on the gas tax. The governor came in, he's got a bit of swagger with his big election win. You guys got the majority. Is this the way you guys are going to be governing for the next couple of years now? Go big?
Well, I think Minnesotans deserve for us to put the best effort forward to make the state as strong as it can possibly be. And we know there are storm clouds on the economic horizon. So it's really our responsibility to put forward the best package to keep Minnesota strong, to keep it one of the top 10 performing states economically, high income per capita, high Fortune 500 per capita. So I just view it as a responsibility for us to do this job for Minnesotans.
We're also going to be taking on the issues that are important to Minnesotans, the things that affect their lives, and the challenges that we face are great. And this is no time for the status quo. And so we do think that it's important to be to lay out what the costs are of having a world-class education system, a transportation system that works, affordable college and child care, how to have healthcare access that is affordable for people. These are real things that we can do. They will cost money, but pretending like half steps or little half measures will get us there, it doesn't solve the problem. And so we will, I think, be honest with Minnesotans about the cost of doing the things that they say they want us to do.
Based on the activity you've seen so far, are there particular areas of spending that you think or that you would advise might be looked at for spending cuts or to reverse the spending that they've already adopted?
No, I mean, that will be up to the chairs to look at as they construct their budgets. I was thinking you were going to work Thomas Pickering into another question.
I'm only good for one on that.
Thank you.
Thank you.
Good afternoon. So we just want to give some responses to the February forecast. Roughly half $500 million down. That's a significant number. We heard some of the comments from the governor and the Democrats about how that's severe, it's dire. It is a big issue. And I want to say, if it was my home and suddenly I had a 2% cut or a 1% cut in my salary, and then I came home and talked to my wife about what we would do, what we would not do is immediately go out and binge spend. And when I hear what the governor is proposing and the speaker, it's significant spending increases when you have a downturn, and we just think that's very, very unwise. The two things that we really can control here is spending and taxes. And if you, we'll talk later about our budget principles, but one of those budget principles was protecting the taxpayer, but nowhere in there did we talk about a tax decrease. We just talked about protecting the taxpayer, and we'll overlay those budget principles as we move forward, but those are some initial comments.
Yeah, I think, obviously, I think this was something that folks, unfortunately, were somewhat expecting based on the actual revenues that we had seen come in since the November forecast. We'd lost about $400 million worth of projected revenue just since November. I'm actually surprised this isn't worse. When you look at where the losses are, it's pretty easy to see that it's income tax. And it's pretty easy to see that it's the high income earners who are now moving their income out of state. And I know Governor Dayton assured us that this would never happen, but the reality is the chickens are coming home to roost on the governor's tax increases. And they're not coming home to roost, unfortunately. They're taking their nest eggs and they're roosting in other states. And that's what's driving this potential deficit in the future. We obviously have grave concerns about what got us into this situation. It's pretty obvious now that what got us here was tax increases and spending increases. And I can assure you that the way out of this isn't tax increases and spending increases. We need to be very cautious, not just today, but also at the end of session when we're finalizing the state's budget. This is heeding a warning that we cannot ignore. If what we see is what we think is happening happening is what's happening, that if wealthy Minnesotans are relocating to other states and we're losing that revenue, we will not get those people back. And we have to rebuild that revenue from the ground up by growing a state's economy. And we will not grow the state's economy by increasing taxes and increasing spending to force us to increase taxes. So it's time that we all get realistic here and be prudent about what the right course is moving forward.
Good afternoon, Julie Rosens, the Senate Finance Chair. And now that the final numbers are in, it's a little bit sobering, a little rude awakening. And now is the time for the finance chairs to begin their work. So they're going to be off working on the principles that the majority leader just mentioned. One is taking care of people. That's a priority for our caucus. Protecting the taxpayer, controlling the spending, it's out of control, and getting done on time with accountability and transparency. And I'd just like to say, too, that the annualized growth in spending is 2.9%, but revenue is only 2.3%. So the long term of our spending is outgrowing our revenues. And that's the story of the day.
Questions?
Mr. Minority Leader, what's your evidence that people are actually leaving? This just came up and budget officials said this is not happening.
Well, did they say it's not happening? Because when we asked them, they wouldn't say that. And I think that's been the case. Look at what's happening in New York State. All you have to do is look at the evidence. We've got the lowest unemployment in 2 decades. We have wages that are still increasing, but somehow we're losing forecasted income tax revenue. Or, the only real explanation there is that some of our taxpayers are no longer paying in the state. We can,
Because they're aging?
Yeah, they're just retired.
I mean, it's an aging state.
Yeah, they talked about the demographic.
Well,
The demographic.
And I'm sure that they want to deny that wealthy Minnesotans are leaving to other states. Last year, the wealthiest Minnesotan left Minnesota. He's no longer a taxpayer in this state. He's a taxpayer now in Florida, where they have no state income tax. We are literally paying people to leave this state. And we can't rely on our weather to keep retirees here anymore. We have to be competitive. I know that these changes at the federal level, while they benefited 95% of Minnesotans, the reality is because of those changes and the fact that we haven't complied at the state level, the wealthiest Minnesotans are bearing the brunt of that here in this state. And they will. There is a threshold. I've been warning of that for 6 years now. There is a threshold where they will move their income and shelter it in a state that has no state income tax.
I want to add to that. Wouldn't we have seen that tax
Let me
rate
add to that first, please.
Well, but can I just real quick?
I'll add to it first. We didn't get a definitive answer from them. We did ask that question, but you can look to New York, which is also a very high tax state for the high income earners. And the Democratic Governor Bloomberg there said that they were leaving their state. So we don't have the data yet, but we can look to another state very similar to Minnesota that they are confirming that that is what's happening.
We have seen that tax rate sooner. Those tax increases passed 5 years ago. There's been a string of surpluses since.
We asked this morning if they had that data, and they told us they didn't have the data to show that people weren't leaving the state. So I don't know how they told you that, but I'll let Garofalo step in. Go ahead.
But it's related to the SALT deductibility, the lack of deductibility of full deductibility of state and local taxes. I mean, that's what's causing people to be paying more in taxes. That's a federal.
So, first of all, we have really high income taxes in Minnesota. The $10,000 cap at the federal level on state and local taxes impacts our wealthy taxpayers more. So this idea that somehow there's a bottomless trough of money and the rich are just going to sit here and keep paying it, I mean, the chicken, as a Minority Leader Dowd said, the chickens have come home to roost. We lost $370 million in income tax revenue in 3 months. I mean, and we're not even in a recession. The economy's growing. Sales tax revenues are stable. Unemployment is going down, and we're losing hundreds of millions of dollars in income tax revenue. So, Brian, did you have a more technical question? You want me to? I mean, workforce participation is up. Sales tax revenues are coming in at forecast. So the reality is, whatever people want to think about the Democrat tax increases, what they did is they put all our eggs in one basket. They put a whole bunch of the tax code on a very narrow sliver of people, and now they're leaving.
I'm just trying to understand the linkage between the Dayton increase from 5 years ago and this one. You're saying it's because the Dayton increase happened, and now they no longer have the buffer of the state and local deductions, so they're feeling the brunt. That's why you think they're leaving now.
Right, because what used to happen, so it's a cumulative factor, but what happened before is that whatever tax increases those individuals had, they were able to write off a portion of them. Now they can't. So I don't really care if people want to blame Mark Dayton or blame someone else, but I will get mad at people who deny it's not happening, who claim that this isn't actually occurring. Just go out to Bear Path and see how many houses are for sale. Well, it's a gated community, so you can't, but, so.
Mr. Majority Leader, can we talk about the demographics on the workforce? Because they said that really is the most persistent concerning, looking forward, that Minnesota's workers are aging, our unemployment is down, and our workforce is down as well, and that it's just going to be a collision course, and we need to attract new people to move here, and especially immigrants. They called out that we cannot fill these jobs without bringing in immigrants here.
So we all agree that we have a workforce shortage and we have an aging of our population, so I think we can work together on those issues. It is attracting other people to Minnesota. How do we do that? Well, we have to be competitive on our tax structure, we have to be competitive on our regulation structure, but it's a great state to be in, so we have to work at attracting them. We do want all legal immigration. We want lots of legal immigration. That's a place that we can agree on. And then we have to figure out other ways to get people into the workforce. One of them, there are people, I don't know what the exact number is yet, but that are able to work but are on our welfare system. Somehow we have to get them back into the workforce. There are going to be solutions that we'll have to figure out together there. So a number of things we can do. One of the other things that I thought of is if we allow our state government to become more efficient, we don't need as many state workers going forward, and they also can get into the private sector. So lots of things we can do, but we have to figure out how to work together.
Is your president helping attract new workers and immigrants to this country and to this state?
I can only speak to his State of the State speech where he said, or State of the Union speech, excuse me, where he said we want all of the immigrants that we can have coming into America, but we want it legally, and so I support that issue.
Mr. Leader, to the issue that your House friends teed up, are you going to be seeking to reverse that top tier or get rid of the fourth tier that they say is pushing people away?
At this point right now, with the forecast that we have, our goal right now is going to be to figure out how do we live within our means when we have very little money going forward. You look out 4 years and we're actually negative spending, and so that's my first job, is to make sure we can live within our resources without raising taxes. That means that we have to figure out how to slow the growth of spending.
The governor says that this is now exactly the time to what he calls invest in new programs in transportation, including some tax hikes to generate more jobs. That's what his theory is, that this will move Minnesota forward.
I'm glad you thought it was a theory, because in the end, that runs counterproductive to what we should be doing. And earlier I gave the example of a home, and if a family suddenly has less income, you don't go out and suddenly spend more money. You tighten the belt and figure out how you're going to live within the resources you have. More tax increases are counterproductive. You could make that argument to me if we weren't in the top 5 tax states. We're already in the top 5, and so my goal is to get out of the top 10. I'm not interested in being in the bottom 10. We like a lot of things in Minnesota that we're willing to pay for, but we don't want to move up from where we are. We're already losing Minnesotans to other states.
I think you already.
If I can just jump in on that too, the governor's comment that he wants to create jobs to get us out of the problem doesn't really make sense. We have a workforce shortage right now, and we have the lowest unemployment rate in 2 decades. The problem isn't that we don't have jobs and don't have people in the workforce. The problem is that the high-income earners are leaving the state of Minnesota, and that's really clear in this forecast.
Mr. Leader, the governor said Republicans' answer to everything is cut taxes, cut taxes. Cut taxes. Your response to that?
I don't think anybody up here is proposing to cut taxes today.
Well, how do you get out of the top 5 then?
Well, we would like to, but you can't cut taxes and create a deficit. That'll create that'll exacerbate the problem. What we're doing is talking about just being reasonable and using some common sense and not overtaxing and overspending. It's raising taxes and being the high tax state that got us into this problem. And what the governor's doing is wanting to put $3 billion of new taxes on top of Minnesotans who are already some of the highest taxed people in the country. That will only make this problem worse. And this revenue forecast forecast clearly lays that out. That is exactly the wrong course of action right now. What we need to do is be prudent and try to grow our economy and build an economy by attracting new people into this state to help bolster our income tax revenues.
Mr. Majority Leader, can I follow up with you? The governor said specifically Republicans and you are saying no to transportation, no to education, no to healthcare, no to bonding. He said no is not a plan for the future.
Well, the fact is we are yes for education, yes for transportation, yes for bonding in its right time, which is typically the non-budget year. Always we look towards education and how do we make sure we do the best we can. In addition to spending increases, I'm also saying innovate. What are the things that we can do to make it more efficient with what we do? And transportation, both Kurt and I, last 2 years, we actually increased transportation funding ongoing. We took half the sales tax on auto parts. That now goes to roads and bridges. That is ongoing. So we are investing in the things that we believe Minnesota cares for.
Wiggle room on bonding, any chance you'll take some bonding?
You know, in the non-bonding year, they're often...
They point out there's been a bonding bill every year the last 30 years except 2.
Yeah.
So they say it's a myth to say non-bonding.
Non-budget year, there often is a small bonding bill, and we're going to have a discussion about that. But the major bonding bill, we want to get back to the every other year, which is where I think it should be.
You mentioned that in about 4 years out, the spending will be larger and with this projection than the money coming in. So with that in mind, in the Healthcare Access Fund, that's the same time that they project $919 million deficit about 4 years out. So can you talk a little bit about that?
Well, it creates a real challenge for us, and that's why we have to figure out how to work together to bend the HHS spending curve. I may be wrong on this number, but I think it's about an 18% growth. Compared to the overall budget was 8 or 9%, and so how do we slow that is the big task that we all have before us. And so sick tax is going away, so now what do we do about it?
This would be for whoever wants to take on this. Why aren't we seeing wage growth? We've got this labor shortage, we've got whoever wants to tackle it. I mean, shouldn't we be seeing more wage growth? And they're even projecting that it's soft out into the out months and years.
I don't have the numbers on that if somebody else.
Yeah, I mean, we are seeing wage growth. They're still projecting wage growth, but they're reducing the amount of increase that they were projecting.
Even what they're projecting is not as much as you would think when you have a labor supply situation like Minnesota has right now.
I mean, Minnesota isn't a very competitive place to do business anymore, and that's the reality. You know, we need to see that sort of wage growth, and if we don't have workers to fill jobs, it's tough to see that sort of upward movement as well. The problem is we're taxing people way too much in this state, and our high wage earners have left, and a lot of those people are small business owners, and some of them are retirees that have substantial wealth, and we're seeing that wealth leave this state.
But if I need to hire somebody and I'm in a competitive employment situation, wouldn't paying more give me an advantage in getting the workers that I need? But we're not seeing that in any substantial way.
It would not surprise me long-term if rates do go up because we have a labor shortage. You find that people have to compete for employees, and so the benefits tend to go up, which is a good thing. And let me make one last comment before we go here, too. I will say that the governor and myself and Speaker Hortman are having good communication. There are some things that I think we'll announce in the next couple of days where progress is being made. And so the good news is we're not below the water on this. It's just that we have to pay attention to what we're doing. But there are some things that are moving forward, and I'm still optimistic.
Your counterpart.
Thanks, guys. We got to wrap it up.
With Chair Rosen, your counterpart in the House in the next couple of weeks, he'll be kind of putting his cards on the table as to the target areas. What are you looking at in terms of timeline?
Well, we are having that discussion next week. As far as targets, there's no clear definition of when those are going to be set. So, but we're starting the conversation, and everyone is looking at, as I said, accountability, pressure points. Where can they do with less? Because this budget, we can't increase spending. It's automatic increase in Health and Human Services of $1.5 billion, $711 million in E12, automatic increase. So this is not really a good day for the budget.
So stay tuned.
Thank you.